Welcome back to this Money Control live stream. You're watching Closing Bell with me, Nandita Khemka.
And I'm Santosh Nair.
Well, it was a day of recovery today. Traders and investors will be heaving a sigh of relief after seeing some bit of green on the screen. 3 days have been tough, especially, the Wednesday's crash, when we saw somewhere around 2,000 points being shaved off from the Nifty Bank index, right? But today was a day of recovery. 21,600 is where we are at. On a closing basis, we have managed to shut shop above that 21,600 mark, which is a crucial level. 21,622 was the 20 DMA level that we violated on Wednesday, and now we are back at that level. So some bit of relief coming in there. Strength in broader end of the markets. Both the Nifty mid and small caps have gained in excess of 1.5%. And if you look at the advanced decline ratio, 2.2:1. That's the NSE advanced decline ratio. Barring the banking pack today, most of the indices, sectoral indices were in the green, led by energy, metals. These are some of the pockets. Autos, among gainers, but banks, they were in the green in the first half of the trading session. But they succumbed to selling pressure in the second half. The likes of IndusInd Bank weighed heavy. Even HDFC Bank, after the ADR snapped its losing streak yesterday, we started the day in the green when it comes to an HDFC Bank. But second half of the session, even HDFC Bank succumbed to selling pressure. So banks once again in a spot of bother here. Extending losses, but aside of that, Santo, the texture of the market looks pretty okay, at least for today. Going forward, if you look at the Nifty, on the gaining side, you have the likes of ONGC, Bharti, Airtel, NTPC, SBI Life, and some of the technology stocks as well. Some bit of buying interest there. On the losing end, HDFC Bank, IndusInd Bank, Kotak Bank. So all these banking names, and of course also Reliance Industries, ended mildly in the red ahead of earnings. And HUL is one stock, of course, in focus. Numbers have just about come out right now. We'll come to that in a bit. But Santo, what is your prognosis after 3 days of hammering? We've seen some bit of relief today. Do you think this is just a dead cat bounce, as they call it? Or do you think now we have kind of stabilized a bit after the shocker from HDFC Bank?
Well, Nandita, still a little early to say. I would caution against, thinking that the trend has reversed and now we are likely to go down. But at the same time, today's bounce that we have seen, also it again would be a little too early to assume that things are looking good, because there are two factors at play. One is that valuations are pretty expensive, so there is no disputing that. If you look at most sectors, stocks are beginning to look quite expensive. They are definitely not cheap. You could argue that earnings are the earnings trajectory for many of these companies are looking good, but at the same time, there's no disputing that valuations are expensive. But at the same time, you have a lot of investors still waiting to put in money. So right now, it's a kind of tug of war between expensive valuations and money waiting on the sideline, and it's early to say which side will win out for now. So yes, some kind of a bounce was only to be expected. We had 3 days of fall, so some bit of short covering usually sets in. Then you have investors who have not participated in the market so far. They see the correction as an opportunity to get in. So to that extent, today's rally is not very surprising, but I would think that at this stage it doesn't make sense to go overboard on either side, either entirely sell out or double down thinking that market is expected to go up. Although the probability is very much the odds, I would say, are in favor of the bulls at this moment, purely because of all the liquidity in the system at this point.
Right, Santo, if you look at the broader end of the markets, you can still see all of these railway stocks. They are flying off and they are rallying at breakneck speed, right? Today you had RVNL, that stock was, up in double digits, once again IRFC for that matter. What are you making of these rail stocks? Do you think they are, flying off the handle ahead of the Ayodhya event, or do you think, it's something that is going to continue here on as well?
Well, I think at this point, anything PSU is quite hot with the investors. This is in stark contrast to the situation till a couple of years back, where the market were extremely mistrustful of PSU stocks, because they always felt that shareholders would get shortchanged in the longer term. But now that perception has changed. The earnings is looking good at this point in time, especially railway. The government is investing a lot of money in railway capex, so that is one of the reasons you're seeing this kind of bull run in these stocks. But at the same time, Nandita, we must also be cognizant of the fact that valuations again, they're fairly, I think most of the positives have been priced in. Yes, the orders have been won. Now you need to execute these orders and realize the revenue. So it's still an if at this point in time. Everything looks priced to perfection at this point, and any kind of disappointment, that could result in a very sharp sell-off. Like we saw in the case of HDFC Bank also, they managed to maintain the net interest margin, but that simply wasn't good enough for the market. So if there's any kind of disappointment, given the way prices have run up, I would think that one needs to be very careful.
Right, of course, tread with caution when it comes to some of these high flyers, right? But anything in particular that's catching your attention in the mid-cap end of the markets, from the last few days, Santo?
Well, let's look at the stocks on my watch list this afternoon. Aarti Industries, you mentioned mid-cap. So this was clearly one of the big gainers among mid-cap stocks. Now, Aarti Industries, the stock was under pressure after its first and even second quarter earnings, because the outlook for specialty chemicals was not all that great. Many people still feel that it's still a little too early to be buying into specialty stocks at this point in time, given that the outlook for the current calendar year still doesn't look all that positive. But Morgan Stanley is taking a somewhat positive view on Aarti Industries. It has called the stock an overweight with a target price of 575 rupees. Now, according to Morgan Stanley, the company's bagging a 6,000 crore order. Now, this is the second long-term contract that the company has won in almost 2 months. So that's a big positive for the company. Also, both the customer and the product both are. The customer is also an existing one, and the product is also something that the company usually sells. So this, according to Morgan Stanley, shows that there is fair bit of visibility for this product. So that's one of the reasons the brokerage has come out with a bullish view on the stock, and we have seen the market also reacting very favorably. But whether this can sustain again has to be seen, because it's been under pressure for a long time. Heavy volumes today, that would almost indicate that there seem to be a lot of believers in the story, but we'll get to know in a while.
Right, Aarti Industries there yesterday also saw a fair bit of up move, and today as well buoyant in trade. But let's talk about UltraTech Cement. Nifty company reported numbers today. Numbers have beaten estimates. It was among the gainers today, 2% kind of gains coming in on the stock price. Third quarter profit has beaten estimates, aided by lower input costs as well as strong demand. In fact, profits have surged 67% on a YOY basis. Even revenues have grown somewhere around 7% or thereabouts. Decent. And government's increased focus on infra and well as rural development is something that is expected to lift cement sales going forward. Even housing demand has been pretty much steady, right? So that's something that could bode well for cement sales going forward. And of course, there have been a couple of cement price hikes as well that has also aided earnings for some of these cement giants, particularly UltraTech. In fact, Fitch in its report in September has pointed out that India's cement demand is expected to grow by somewhere around 6 to 8% over the next few years, and that could bode well for a company like UltraTech, right? There was a slowdown in cement demand back in December due to the state polls, as well as there were some floods in some southern states as well. So that had impacted cement demand. But going forward, this being an election year, there would be increased focus on infra spending and rural development and stuff like that, and all that will bode well for cement companies, particularly UltraTech as well. Lower prices, as I mentioned, lower input costs with fuel costs coming down is something that is seen as a fillip for cement firms, and the cost saving measures that the company has taken is something that will benefit the company even in the coming quarters, because power and fuel together account for somewhere around 30% of total costs of UltraTech Cement. So on that front, it has seen a bit of a reprieve. Going forward, MK in its report in November had mentioned that in the second quarter, Cement makers saved somewhere around 80 to 100 rupees per ton due to lower fuel cost, as I mentioned. So this has come as a fillip, and it will continue to reap good benefits for some of these cement giants. Also, the fact that UltraTech had announced the acquisition of Kesoram Industries a month ago, and that will bode well for the company, given the fact that it will have access to 2 units in Karnataka and Telangana with a total capacity of 10.7 million tons, right? And it will take UltraTech closer to its goal of 200 million tons capacity by FY28. So that bodes well, and it will also help the company increase its footprint in the southern part of the country. So all in all, the acquisition plus the earnings coming in better than estimates, something that will provide a fillip to UltraTech Cements. In fact, even the coming quarters are looking pretty much promising. CLSA in fact had mentioned at that time that the company will continue to grow faster compared to the industry and other peers. If you look at the stock, Santo up 40%, nearly 40% in the last 1 year, and return on capital employed is higher versus other cement makers as well. Morgan Stanley also had come out with a report saying that the acquisition will be incrementally positive for UltraTech Cement. So all in all, things looking good for UltraTech Cement here on.
Definitely, and there is the chatter about continued M&A activity in this sector now that one of the largest players is back in action. That's also something that's keeping cement stocks in the limelight. Well, with that, the last stock on my watch list this afternoon is IndusInd Bank. IndusInd Bank now came out with its third quarter numbers. By and large, the numbers are in line with what the market has been expecting. We have HSBC, Jefferies and Macquarie, who have all come out with positive ratings on the stock. In fact, HSBC and Jefferies have rated the stock a buy. The targets are in excess of 2,000 rupees, whereas Macquarie has an overweight rating on the stock with a target price of 1,900 rupees. Now, according to HSBC, the operating numbers were mostly in line with expectations. However, the only point of concern is that slippages have been on the rise. But at the same time, it is said that the management is fairly confident of keeping slippages in check. Whereas also HSBC has projected a 21% increase in IndusInd Bank's EPS over the next couple of years. And according to Jefferies, the net interest income growth of about 18% is one of the best in the category, and it's also flagged the fact that the retail book has grown by about 24%, which is also fairly strong given the business environment. But at the same time, Nandita, what seems to be happening here is that HDFC Bank's third quarter numbers seem to be still weighing on market sentiment, and there is some bit of skepticism whether other banks, if HDFC Bank is finding the going so tough, if other banks will be able to maintain their operating performance in the quarters ahead. That seems to be one big concern which has dragged down IndusInd Bank. So IndusInd Bank was among the prominent losers of the day.
So ICICI Bank and Kotak will be reporting their numbers over the weekend tomorrow, right? Of course, margin pressure was expected as deposits are still getting repriced. With respect to HDFC Bank, the slowdown in deposit growth is something that really came as a big disappointment, and also the liquidity coverage ratio coming down. That is also one factor that didn't go down very well with the street. But with respect to peers like Kotak and ICICI Bank, do you say the margin pressure factor is already priced in, or do you think we are still going to react to that if there is some bit of disappointment thrown up by the likes of ICICI and Kotak as well?
Well, see, in the case of Kotak, the stock has been now been underperforming for quite some time now. So already most of the negatives seem to have been priced in. If at all the company does manage to surprise, maybe you could see a fairly good run up, given that expectations are running pretty low. Well, it's not just with HDFC Bank, but in fact most banks are seeing a sharp rise in the price of their deposits, because interest rates have remained high for a while now. Obviously, to attract new depositors, you need to pay a higher rate of interest also, because the stock market is booming, and when the market booms, a lot of incremental money goes into equities. People don't really want to put money in bank deposits, so that is where banks are facing that challenge. So it's not just a case of a specific bank, but the general trend, if you see, more money is going into the equity markets, and I think that is slightly an incremental negative for banks.
Right, of course, banks have been in focus, all of the week and even next week. In fact, tomorrow and next week, banks will once again be in focus as we await numbers from some of the Nifty companies like ICICI and Kotak Bank. But the last stock on my list is PVR. It being a Friday, I thought might as well choose the media and multiplex stock. Elara Capital has come out with a report. It has upgraded the stock to buy with a target price of 1900, which implies a 28% upside from current levels. Elara believes that the content pipeline will only improve in calendar year 2025. Only because the fact that we had a Hollywood writers strike, right, and that could impact, that would impact rather the English movie pipeline, right, and even when it comes to the Hindi movie pipeline, in 2024 there are no big budget movie or very less big budget movie releases slated for the year, which is why 2024 movie pipeline and outlook on the stock is attracting a bit of caution from Elara. But for 2025, as the impact of the Hollywood strike wanes off, Elara expects a whole host of English movies to be released, and even Hindi movie pipeline looks pretty solid for the next year. Because of that, Elara has pointed out that occupancy levels may improve, but it will only reach 85% of pre-COVID levels, even in the best case scenario. That is for FY26 as well. And digital content and OTT have already eaten some bit of market. In fact, some bit of have impacted footfalls rather for some of these multiplex stocks. But that also will get balanced out because there are premium offerings from multiplexes in terms of screen. You have all the IMAX, 4DX and the likes. Plus, improved food offerings is also something that draws people to the multiplexes, right? So these are some of the issues that may or some of the factors that may pull audiences back to the theaters. But if you look at the stock, particularly, it hasn't really done much over the last 1 year, has gained just about 3% or thereabouts, and currently it is trading at premium valuations of some around 16.5 times to FY25 EV EBITDA. But Elara says that the risk reward is favorable as the valuation appears compelling at the current juncture, and synergies of the merged firm PVR Inox will flow through, and size and scale of the entity as well as acceptance of regional content is something that would drive a re-rating where PVR is concerned, and it will also help the company to sustain its premium valuation. So that's one argument that has been put forth by Elara. And recently even ICICI Securities came out with a buy call on the stock with the target price of 2240. So I think picture abhi baki hai when it comes to the likes of PVR.
Well, and with that, it's a wrap on this edition of Closing Bell. Thank you for watching.
Yes, but Santosh, I want to just remind our viewers that tomorrow is not really a market holiday, so we can't really say enjoy your weekend because we have 2 hours of trading tomorrow as well. 9:15 is when the markets will open and will trade till about 10 o'clock, and then there will be a second session just about 1.5 hours from there as well. So we will be getting you live coverage of when the markets open at 9:15 in the morning. So don't forget to tune in for that. Of course, Santo will also be joining us for that. So we will get you market coverage tomorrow. That's a Saturday morning at 9 a.m. So don't forget to tune in for that. But for now, goodbye. Thanks a lot for watching. Stay tuned to Moneycontrol for all your other news and updates.